Good morning, everyone, and thanks so much for joining us on this webinar today. I'm Jill Zozula with LSL CPAs, and we're really glad to have you here. So before we get started with our webinar, Pitfalls to Avoid When Selling Your Business, I'm just going to go through a few quick housekeeping items. First off, I want to let you know that this webinar is going to be presented in a discussion format. So our presenters are going to use a lot of stories and examples. So we're not going to load you down with a bunch of slides. It's going to be more of a conversation with these professionals. Later today, you're going to receive a recap outline of everything that they discussed. So be on the lookout for that. If you have a question, just look for the chat bubble icon at the bottom of your screen. So if you hover your cursor down to the bottom of your screen, a toolbar is going to pop up. Look for the chat box, click that, and then pop your question in Q&A, and we'll get that question. We'll wrap the presentation up at 10:50 a.m., and we're going to leave 10 minutes for questions, and we'll end promptly at 11 a.m. And lastly, we're going to be sending out a link to the recording of this webinar later today, so you can listen to it again and share it with others. So now I would like to get going and introduce our speakers. Okay, first off, we have Pam Bustos, and she is a CPA and a partner at LSL with over 20 years experience in tax planning for multi-state high net worth individuals and their closely held businesses in real estate, professional services, and wholesale manufacturing. Let's see, let me just move this along here. Next, we've got George Lanza, and he's the co-founder of Plethora Businesses. With more than 30 years of experience in management, consulting, business valuations, mergers and acquisitions, George is a recognized leader as an M&A advisor and business valuation appraiser. He's been involved in more than 1,500 valuation engagements and successfully closed more than 250 merger and acquisition transactions. And next we have Robert Farnhorst, who is a director and manager at Plethora Businesses, and he has over 18 years of experience in the M&A industry. He advises clients in the acquisition and sale of lower middle market companies. At Plethora, he's directly responsible for the completion of more than 60 transactions, including traditional sales, recapitalizations, and mergers. And last but certainly not least, we have Nick Lanza, and he is a vice president at Plethora and is a member of the transaction team. He's been with Plethora for 9 years, and in addition to working on sell-side transactions, he's the director of Plethora buy-side division. So I'm gonna let you know about our learning objectives today. Number one, we're gonna assess key management and owner involvement. Number two, we're gonna look at companies' ability to withstand the rigors of due diligence. Number three, we're going to look at the type of offers a buyer may make and their tax implications. And number four, we are going to look at minimizing seller liability post-closing. So first off, assessing key management and owner involvement, and I'm going to hand it over to you, Pam.
Hi, everyone. Thanks so much for joining us today. I'm excited to be working with Plethora Businesses. Just wanted to share that I've referred clients of mine that they're currently working with, and they're assisting them hand in hand to position them for sale even years in the future. So this is a really valuable resource that we are coordinating with today. Very talented and highly experienced professionals. Our first topic of assessing key management and owner involvement. For George, my first question is for you. Generally speaking, how important is the management team and the value of a business?
Well, the management is very important for any enterprise. Depends on the type of buyer, it could be critical. For example, we have different type of buyers. If the buyer is synergetic, it is very important, but by being synergetic, the buyer might have already some management team that he can bring into the transaction. Now, on the other hand, if the buyer is a private equity group, it's very crucial. Why? Well, you need to understand how the private equity group works. Usually what they do is they purchase a company and they will flip it within 3 to 7 years. So, and oftentimes they don't have the time to be able to develop a new management. So they expected to have the management in place. If they don't, they might just pass the transaction just because of that. Now, not only the first tier of management, but the second tier of management is very, very, very important. And it's very important that the management be able to answer some of the questions to the buyer, so the buyer feel comfortable about the management and who they're going to be working with. Just to illustrate it, and we're learning through experience, and I've been doing this as a team for so long. We have so many stories on it. We have one story that very well illustrate how important the management is. We had a company in the food industry. The seller have started the company literally in his garage. Well, here is 20 years later, the company is doing about $20 million in sales. So he has moved the company slowly all the way up to 20 millions, and he was ready to sell. But like most owners who started in the garage, they have grown and growing the company, but they have not been growing, the experiences of how to manage or how to market the company. But we encouraged him to start bringing some management into time, and he moved one of the engineers that he had in the plant to a general manager. Well, at that time we were ready because he needed to retire, and he had a limited time for him to stay with the new management. So we market the company, and we received several offers. One of the offers, and the most important one, it was for a large private equity group from Chicago. He interviewed the seller on the phone, did some previous preliminary, per se, due diligence, and he was satisfied. And then he decided to have a management meeting with the seller. Well, upon getting together, the seller showed up, and he wasn't, according to the private equity group, and I was there, he wasn't what he see as a leader to take the company to the next step. Well, our defense was, well, he brought the company as far as he could. We need now a new management to bring it to the next level. One of the things that the private equity group say, we don't have the time to start training managers right now. We need somebody who not only know how to drive the forklift and how to bring the company to this level, but somebody who had the future and the vision to take the company to the next levels. And this person didn't have it. So that particular private equity group passed. So we need to retool, recap, and be able to concentrate into having the next buyer to be a synergetic buyer. A synergetic buyer will have a little bit more patience because it will bring some result management. And we did that. And by doing that, the company was sold soon after to the right buyer. So again, we need to be able to size who the buyer is, what experience do they have, and sometimes we can help them to get from here to there. But usually we only can do that if they come to us within time for us to work. When they are ready to sell, it's too late for us to create a new management team.
I can see that would be very important. So Robert, for the business owner who currently does not have a strong management team, what are reasonable expectations they should have about how this may impact the sale process?
Sure. So if a company doesn't have that management team in place, the buyer is going to really kind of look at it and say, well, we can't buy you, the owner. And so if you, the owner, are having plans to exit the business, you need to be prepared to stay for an extended transition period. And sometimes that could be up to as long as 1 year to give time for the new owner to identify an executive to bring in and get them trained and up and running in the business.
Yeah, actually, Robert, one of my clients who had a major sale probably 3.5 years ago, it took a full 3 years before the principals fully retired. It was a very large sale of a $350 million revenue company. So I can see the larger the sale, the stronger the management team they need to have in place for a transition.
Absolutely. We just completed a transaction in January, and what we had worked out in this case, similar scenario, is the owner was clearly involved in the business, but he wanted to retire. So we worked out a deal with the buyer where the owner would commit to an employment agreement for 6 months. And the plan is the first 3 months is to identify the replacement executive. And then the subsequent 3 months, we would train and onboard that individual. So we were able to shorten kind of that perceived 1 year transition down to about 6 months.
I can see. Nick, what are some questions you ask business owners to get a sense of the strength of their management team?
One of the questions that I usually ask an owner when I first begin to get familiar with the company is, how long can you take vacation? How long can you step away from the business and not have to answer your phone, not have to respond to a fire? If the answer is 2 weeks, 3 weeks, I mean, that's great. But if it's 4 weeks, that's even better. I think sometimes what happens is you have an owner that is more involved in the business than he may realize. So when they'll tell me 3 weeks I can go on vacations, okay, well, during those 3 weeks, are you taking phone calls? Are you answering emails? If there's a problem that, a customer has with, product or some sort of fire that goes up in the business, are you the person that gets called? And, second to that, that gives you a good sense as to how needed and how required the owner is in the business on the day-to-day. Another question I ask is, what do you do on a day-to-day basis? What do you personally oversee? Are you in charge of pricing? Are you the sales guy? Things like that give me a better sense as to who is the support that you have around you. I think the last thing that people want to find out, especially a buyer, is that there's so much knowledge base that's tied up with the owner that when the owner leaves the business, a lot of that good.
I think you guys froze. You may want to check your feed real quick.
Price of the business. So it's very important that we just work with that beforehand.
And also there's, there'll come a point in a transaction where a buyer's made an offer and you're now sitting in a conference room with them and they're meeting you for the first time potentially. And we find sometimes that the owners have such a sense of pride in their company that they feel attached to it, and they use, their responses use the word I a lot, where we try to guide and coach our clients to say, let's talk about the team. Let's talk about the people that are adding value in these ways. So it's more of a we discussion rather than just an I approach.
Oh, so Robert, so in the situation where you determine they may not have a strong team, or perhaps they haven't identified, you can then coach them to get that team in place for a future sale?
Correct. So oftentimes if an owner's thinking of maybe a sale in 2 to 3 years, we do an assessment and we look for gaps in the talent, basically in their management team. And we try to figure out, okay, where do we need to fill in those gaps? Do we need to hire someone, or do we need to maybe expand the role of their current team to maybe cover a few more responsibilities? So we, there's that really strong team there when the buyer does eventually come in and review the business.
Another thing, if I can add to the discussion, sometimes you'll find that, an owner and their spouse will be involved in the business, and the spouse too will have a set of responsibilities that they're carrying out, whether that be payroll, marketing, or some other, core responsibility of the company. And that's an area too, that if you don't really understand the dynamic for any family members that are working in the business, that could really present a situation when you're having a discussion with the buyer, they're going through the organization chart, and they say, okay, well, who's in charge of this department right here? It's like, well, that's the spouse. It's like, okay, well, are they planning to leave the business as well? Then all of a sudden you have a vacancy, which, on the initial discussions, unless you really peel back the onion, do not uncover. So that's another element that I think is important to, for the business owner to really understand and be honest with themselves. Who do we have in the business? And if we leave, what holes or gaps are there?
Yeah, also the management affect all aspects of the sale. Even the financial arm, maybe a bank or maybe an institution is going to finance the transactions. They want to make sure that they minimize the risk by having a second tier management in place, just in case the buyer, get hit by the president, get hit by a bus. So it's very important.
Yeah, those are all very good points. Okay, we're going to move on to our next topic, the company's ability to withstand the rigors of due diligence. So for this topic, my first question is for George. What are the most common challenges you have seen for a business owner going through due diligence?
Well, if I had to put in a short sentence, I would say deal fatigue. Why is deal fatigue? Deal fatigue will set in when the seller they are not prepared. Back again, if we had the time to prepare the seller for the sale, we will have him start preparing not only the financials, and the financials should be according to GAAP, and it should have a good explanation for each one of the lines that they have, be able to prepare all the perks that the owners might be able to enjoy and be able to have all these certifications with it, but also to be able to do disclosure schedules. Disclosure schedules means that you have to disclose to the buyers and to the buyer's attorneys everything that happened within the company, sometimes since inception. Why is that? It's because things will go back all the way down to 10, 15 years that the buyer will want to know what happened in those cases. So we wanted to disclose. And when the buyer starts asking questions, it's a marathon, literally. So it will take about 3 months, 2 to 3 months of due diligence, in which is a lot of, the question goes all the way down to very micro on it. So it's very important that the seller be well prepared and they have a good explanation for everything. We have a case that I think will illustrate it pretty well, in which the disclosure schedules saved him for many millions of dollars. We were selling a company who distributed seafood, one of the largest seafood distributors in the West Coast. The company is located literally in Nevada, in the city of Las Vegas. The company was there for 42 years. And when it was started, it was right in the middle of the downtown Las Vegas, where right now is in the middle of downtown Las Vegas. And it's a very large corporation. It's 4 acres, so it's about a square block. Well, we sold this company with about $9 million of inventory. And the inventory is something that you have to have very well accounted for, because it's part of the asset. One, to use the financing, and second, just to establish the price. Well, going through the due diligence towards the end, we find out that they were missing 30 tons of seafood. That is a lot of lobster walking down Main Street in Las Vegas. So everybody was just dismayed with what's going on. So the seller was just completely out of control. So he called the insurance company and reported it. Well, the insurance company started asking questions, and he called me. And I said, George, this is what's happening. I said, well, call the insurance company. Tell them there was a misquote that you don't need them to cover you. The reason is 30 tons of lobsters and crabs is a lot of things to be leaving in 1 week. It's been going out of the door or somehow for about 42 years. So you cannot establish the pattern on when will disappear. So why we have that? Because they did not conduct physical inventory every year. What they did, since the inception, they got a computerized inventory. So inventory come in and inventory go out, and whatever is left, that's your remaining inventory. Well, apparently the remaining inventory wasn't there. This company have huge freezers throughout the company. Company, like I said, it was a square block. So easy for drivers coming in and out all the time for just boxes to disappear. I know it's not good to say it, but it's the reality. So at the end, the $9 million of inventory wasn't there. It was part of it, but a majority was already out. So that created a problem. Well, but we have all the other disclosures in place. So to complicate matters, and I know sounds like a deal from hell, but to complicate matters, the transaction closed at noontime, a given day. It was about a little bit over a year ago. It closed at noontime. By 4 o'clock, the company caught on fire. And it was all over the news. Seafood company in Vegas on fire. One of the large freezers was leaking ammonia under the ground, explode, and catch on fire. Well, this was about 3 to 4 hours after the company was closed. So the seller called me and said, George, this is crazy. Can you see what's going on? Well, we only here log in and find out that the fire department has closed in the city of Las Vegas 1 square block, and they have evacuated everybody. Why? Because it was toxic fumes. Well, the first thing that I asked the seller to do is go to the bank and disturbed the wire. The wire was for many millions of dollars. So what happened that a wire could be recalled if it's not disturbed. So he went to the bank, broke off the wire, so now his money is safe. He went back and we talked, and then we went back to disclosure schedules. Well, here is what saved the bacon. The disclosure schedule has shown who was the company who was maintaining the freezers, when was the routine schedule maintenance, and when was the last maintenance done, and it was all reported. So the next day, the attorneys took over and they wanted to cancel the transaction, recall the money. It was too late to do all that. We already have everybody cash their own money. So we needed to dance. The disclosure schedule saved the transaction and saved the seller for had to return all the money. So that's how important it is. So, you know, Robert, Nicholas, myself, we all emphasize the disclosure schedule. And I know they can probably have stories of their own, but that's just one example of how important they are, Pat.
Okay. Nicholas, what are some of the things that a business owner can do in advance to prepare for this due diligence process? I mean, I'm guessing they shouldn't plan it when they normally take their 4-week vacation to see family out of the country. I mean,
Right.
with this 2 to 3 month process, they can't just, you know, they have to pick the right time.
Right.
Right.
Well, you know, I would say that of all the due diligence request lists that I've seen, and that's going to be the document that a buyer will give a seller or give an owner when they're going past the letter of intent, they're about 80% the same from deal to deal. You're going to see a lot of the same requests as it relates to financial reporting, as it relates to legal operations. And when you have a basic format that you already know in advance that any buyer is going to want to request, you can really save yourself a lot of pain by taking the time to prepare it early. So the maintenance records that George mentioned in the last example, in the last story, that's something that I think could really be out of mind when an owner's thinking about getting ready to sell. It might not be in an electronic format. So taking the time to prepare in advance, having your company ready for sale will really save a lot of the heartache through due diligence. We've seen scenarios where due diligence can be really painful and some where it's been really smooth. The ones that have been really painful have been when an owner would tell me, he's like, you know, I really don't want to start having people put stuff together and start giving requests to my administrative staff to start putting documentation and upload it and scan it. Let's wait to see what the LOI says. And once we sign it, then we'll start to get to work on it. And then I'm thinking to myself, you're setting yourself up for, you know, a nightmare, because what's going to happen is once you start populating these data requests, it can be a full-time job if you're trying to respond to it in a timely basis. You still have a company to run. The people that you would delegate these tasks to, they still have their jobs to do. So then you have, on the other hand, companies that are ready for sale. I think that you want to think about due diligence as part of getting your company ready for a sale. And in part of doing that, you're going to save yourself a lot of headache.
Okay.
But
Robert, so how can business owners protect themselves and their proprietary information in a transaction should it not make it to the finish line? And, you know, along with that, you know, is there such a thing as providing too much information or too little information?
Sure. So I think that for most owners, there's always that concern is, you know, we've got a deal struck, we've got it inked. Now they want a bunch of information. And what if they don't get to the finish line? How do I know that they're not just here to try to figure out who my customers are, kick the tires, and then not actually perform? So that's a valid concern I think most of our clients share. And we find that one of the common areas that are of concern is the customer list. Most owners don't want to be providing that up front, but it's so integral to the diligence process, we can't just completely ignore that part of the business. What we found that generally will work is we code the customer names. So instead of saying, here's the list of the top 10 customers, we'll say this is customer 1 through 10. And here's all the supporting data about that customer. It's description, it's, you know, the trends, maybe the margins. And what we do is we redact that bit of data, meaning the customer names, until we get deeper in diligence. Once we see the buyer is fully committed, we see them maybe signing off on other aspects of the diligence process. We see their legal getting involved. Then we say, okay, we feel comfortable that you are fully committed to this process. And then we start releasing some of that more sensitive information.
And there's that saying, if you don't ask, you don't get. And I've seen a lot of instances where a buyer will ask for documentations or ask for names of customers, because why not? If there's a non-disclosure agreement in place, it doesn't hurt to ask. I was in a situation where we were in a meeting with a buyer and seller, and we were just getting going in the process. There was no letter of intent executed. And he asked the owner, okay, Jim, what are the margins that you have with your customers? And he referenced 3 top customers, customer A, B, and C. And, the client, our client was, uncomfortable by the request. And he said, well, I don't really feel comfortable sharing that at this time. And the buyer's like, well, I don't get what's the deal. We have an NDA. Come on, you could tell us we have that in place. So you have to stand firm as to what you're willing to share and disclose and what you're not. Even if, a buyer's being a little, insistent on a data request.
A big part of the due diligence is also the documentation. Yeah. Most owners, they are for the bottom line. And I can understand that. And the bottom line, it is very important. So to that end, they have their own accountant in their business, and the accountant does the work and everything is okay. Well, no, everything is okay for internal. But when you're trying to sell the business, the buyer will really drill in the financials, and they will use something called GAAP. And they will say that even in the LOI, they will say, and the financials, QE will be audited according to GAAP. Well, oftentimes, the seller doesn't know what GAAP is, and his bookkeeper cannot keep up with that. So what he thinks that EBITDA is, and when we come up with EBITDA and with GAAP EBITDA it could be 3 different things. So if he prepares with audited financial statements, well, we applaud that. But if he doesn't want to spend the money into audited financial statements, when I say spending the money, you might spend $10 or $20 or $30,000 for those financial statements, but you might gain $1 million at the end of the day. So the financial statements being audited or at least compiled, it will be greatly, because the buyer will have confidence in the transaction and the transaction will go smoother. You have seen that.
Sure. And what we find is when we're going to market with a company that has reviewed or audited financials, it generates more interest, because a buyer looks at the opportunity and goes, this is great. And then sort of that lingering concern of, okay, the numbers look good, but is due diligence really going to come out clean? Are we going to see numbers similar to what we have now on the front end? When you have reviewed or audited, there's that confidence. And so you generate more interest, and ultimately you could see a higher purchase price for your company. Like George said, it's almost an investment or a return on your investments by taking that approach.
Yeah,
the consequences can be the consequences can be big. I mean, if you have audited or reviewed financials, you're able to have that yourself, that level of comfort. I'm of the opinion that most of the leverage that a seller has is up until the point where they execute a letter of intent. Beyond that, a lot of that leverage goes away. And the last thing you want to be is in a situation when you're going through due diligence, you don't have audited, reviewed financials, you know that your inventory and the way that you're costing it on your P&L is not correct, let's just say, because you're managing the bottom line. You don't want that to come up into the deal and adjust the purchase price. And it's also, you don't want that to be an issue that you have the buyer provide the answer to you. It's like, well, what we discovered is X, Y, Z. You want
I could see that would be very important. So let's move on to our next topic. So we're going to talk about the type of offers a buyer may make and their tax implications. My first question is for George. So George, what are the types of offers a business owner can expect in selling their business?
Well, it depends on the business and depends on the buyer. There are many types of offers that they will issue. And most transactions, except if the buyer is a public company, it will be highly leveraged. When you leverage a company, you have different components in it. You have primary, secondary lender, and sometimes even mezzanine. So to be able to satisfy all those, the buyer will ask the seller one or two things: either to finance part of the transaction, that means not carry back, or just to roll over some equity. Usually, if the company is good and the company have a good future, we recommend to the sellers to roll over some equity. And that is what many people call be able to later on get the second bite of the apple. The private equity groups, they're responsible for about 80% of most transactions in the lower middle market. The lower middle market is established between $2 and $10 million EBITDA. And that's what we do into it. So if the seller will roll over some equity, it will get a second bite of the apple, like we explained before, between 3 and 7 years. And that is a very good thing. There are many other systems, but let me concentrate on the rollover just for this scenario. Robert and Nicola can explain the other two. We have a client that we were closing a transaction, a young gentleman, 36 years old, who has started a logistics company right out of college. Well, here it is, 14, 15 years later, we were selling his company for $70 million, very hefty price. And the company was only doing $30 million in revenue, but the EBITDA was pretty high. So we valued pretty high and we sold it for $70 million. He was pretty young. So he said, they convinced him to roll over some equity. So he rolled over $10 million. By rolling over $10 million, he was equivalent to 1/3 of the value of the company, ownership. Why is that? It's because the part that you roll over will be a percentage of the total equity. In this case, the seller rolled over $10 million. The purchaser, the buyer, put down $20 million. And the rest of it was finance. So now the buyer, because he put down $10 million and was equally owner of 1/3 of the company will be sold again in probably about 3 to 5 years, probably more like 3 years. And they believe that the company will attract about over $300 million in sales price. They're on that tracking. So how that work out? He put $10 million down. Here it is, 3 to 5 years later, he's going to collect 1/3 of $300 million. And you're a CPA, you know how much money that is. So that's what we try to explain to our customers. There is, they hear a lot of rumors. Well, yeah, I want to do this, I want to do that. But there is a lot of options that we can explain and we can coach. And again, we know M&A, but we know more about the transactions, about the result of the transactions, hundreds of transactions that we have done. Robert, maybe you or Nicholas, you can explain some of the other two.
I think it's right. I mean, if you have an offer on the table where they're requesting the seller to provide some financing, I think it could be something worthwhile to consider rolling over equity. If you're going to be carrying a note, or you're going to be on the hook for 3 to 5 years or an earnout, if the buyer is open to you doing so and participating in that equity, I would say that could be a great opportunity. We have a lot of success stories that just do exactly that.
Yeah, I currently have a client who's in the middle of doing that very thing. He sold the remainder of his company for $12.5 million, but rolled over $8 million in equity, and it's allowing him to stay involved with the new company. And so, he's had a lot of faith as an entrepreneur in his company, of course. And now with this new investment and new buyer, joined together forces, he's anticipating a complete sale eventually that will far exceed what he thought he could sell it for outright in the beginning. So Nick, what else can you add about what motivation does a buyer have in making an offer to acquire assets versus stock? And what type of offers do sellers typically prefer?
Yeah, so typically a buyer wants to buy assets and a seller wants to sell stock. A buyer wants to buy assets because he has the opportunity to write up the value of the assets and then depreciate it going forward, which serves as a tax deductions, a tax savings for the buyer. A seller wants to sell stock because there's a difference in taxes. There's typically a higher net proceeds at the end of the day. And so they're at odds at each other at the beginning. But I would say in terms of what we see in practice, most offers start off as an asset purchase. And it really depends on, the type of entity that the owner has. If you're a C Corp, it can be pretty brutal to look at the tax consequence from a sale. So there's ways that we help negotiate the offers and either have the buyer true up the price to reflect what the proceeds would be in a stock sale, and or if the buyer really doesn't want to miss out on the opportunity, he has to make it a stock sale.
Mm-hmm. Yeah, I could definitely see that. I've had that same situation with buyers and sellers too, where, you know, the buyer wants the asset purchase and the seller wants stock. And as you know, and we won't go into great detail here, there are some strategies and structures that can take place to make it appealable to both sides, so that a deal doesn't fall through, you know, given the current structure. So that definitely allows for some planning up front before a sale can close.
Right. We had a situation where we had a deal that, you know, unfortunately didn't come together. The buyer was insistent on making it an asset sale. They didn't want to buy the stock of the C Corp. And when we were going through it, they had this, you know, discussion around, you know, having a strong allocation to personal goodwill. And ultimately, when we were going through the tax, you know, the net proceeds for the sellers, it just wasn't enough to justify moving forward with the deal. It was just, you know, it was significant, the tax consequence. So that can be considerably disruptive.
Yeah, I can imagine that you know, all this planning in advance, it's not just about getting an offer and closing, it's about whether the deal makes sense for even the seller.
Right.
Okay. All right, I think we're ready to move on to our next topic. So this is closing the door to sellers post-closing liability. I've had clients who have sold their assets in their business that, you know, there's high warranty and insurance costs involved, all sorts of things. I had a client who made mobile cranes. They manufactured mobile cranes. As you can imagine, there's a high rate of injuries in that type of work. And so they, you know, were very concerned with this topic. So George, what are some steps that a business owner can take to protect themselves from post-closing liabilities?
Well, it's like in business, the most important thing is location, 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 right? To close the door to liability is disclose, disclose, disclose. You need to have a sharp attorney that is an M&A attorney working in conjunctions with us, with the M&A firm, to be able to find everything that we need to disclose. As long as it's disclosed, it will cover the liabilities. When I'm talking about disclosing, I think I give you the example of the company that got on fire. If we didn't have good disclosures on it, the seller would have lost his company, literally lost his company after, you know, during the day of the sale. So because what's disclosed, we save it. So disclosure, what do you disclose? You disclose everything. All day, like you were mentioning, Pam, that company who does the crane, if anybody got hurt in the past, it need to be disclosed. Even if it wasn't injury, big injury, but a small injury. We're happy with people who twist their backs or do things like that. They might hold up for a while, or they might just float up later, the pain, or whatever the case it may be. And especially after the company is sold and the person doesn't feel comfortable with the new owners, out of the sudden his back might hurt. So it's been disclosed and disclosed and disclosed. And there are some forms that we usually use that they can be used in a way to properly disclose some of the things and have the employee sign on it to make sure that it's nothing carried on to the next. So disclose everything that you can possibly can. We'll be able to close the door to some of the liabilities. Now, in the case of financials, if they find something wrong with it and they claim fraud, that could be a big problem. So, but the disclosures are there, and this is just one area that I work on it. Robert, you've been very involved into disclosures. You probably can give us some samples of that.
Well, I can't think of an example offhand.
Well, you know, I think there's certain post-closing liabilities, or just liabilities in general, that are knowable, and then some that are unknowable. Some that can just, you know, pop up out of nowhere. And I think there's different remedies to be able to protect against that. So, for example, if a tax consequence, or, you know, someone comes in and the IRS does an audit, and they find issues with the financials and the way they were reported prior to the closing date, that's something that is unexpected and really could fall on the, you know, side of the owner, of the seller, to have to indemnify the buyer for the cost. So there's a couple of provisions that you'll find in a purchase agreement that really work together to try to mitigate, to the best extent possible, what liability the seller has after the sale. And the only provision that you have in a purchase agreement is the indemnification provisions. There's really the governing document and how you handle any of indemnification claims. And then a good attorney, an M&A attorney, will protect you by putting limitations as to what you can indemnify the buyer for. And, you know, it can be pretty egregious. I had a company that we sold. It was a physical therapy company, and this was a number of years ago, and they were doing a lot of work with Medicare. And the owner, the buyer, he was buying the stock, and he was really concerned that the seller might have not abided by the strict rules for Medicare. And if he gets audited, Medicare can look back, or the regulatory authority can look back 10 years. So the buyer wanted protection for at least 10 years because he felt that that would be fair. And, you know, consequently, that's not fair to the owner. That's not fair to the seller. How could you imagine selling your business and then being on the hook for it 10 years after the fact? That doesn't make any sense. So ultimately, we agreed to a limit as to, you know, a time frame for where the seller would be, you know, indemnifying the buyer if there was something that arose. But that's where a strong M&A attorney comes in and can help protect you, specifically for post-closing liabilities.
Also, Robert, you can talk about the baskets and limitations.
Sure. So there's a concept as it pertains to liability called your watch, my watch. And it's uncustomary for you to sell your business and kind of wipe your hands and say, I'm done, I have no liabilities. It doesn't work that way. So if you sell a company, the things that happen while you own the business are generally your responsibility. Sometimes, though, the challenge is things might come up after closing that are a result of activities that happen when you own the business. And so there becomes this negotiation in the transaction to do two things: to drive down the amount of liability that you have. Okay, so for instance, if you sell your business for $20 million, you don't want to have a cap of liability of $20 million and basically have to give all the proceeds back. So we try to drive that liability cap down to a nominal number. So at least you know that 80, 90% of what you receive at closing is protected. And so the rest of it is, okay, we set this amount aside, and if something does come up, then we can look at that amount. Now, another way to protect yourself from those post-closing liabilities is something called rep and warranty insurance. And that is a policy that you can put in place so you don't have to be the one indemnifying the buyer. The insurance company will step in and basically make the buyer whole if there is a claim that comes up after closing.
Yeah.
Okay. So along that line, you mentioned, you know, M&A attorneys, and, you know, there's all sorts of other advisors. What professional advisors would you recommend that a seller has on their M&A team? Aside from the obvious, the accountants like myself and the M&A advisors like yourself, insurance brokers, what other types of advisors?
Financial planner is very important too.
Absolutely.
Because unfortunately, it's not how much money you can sell your company for, rather is how much you're going to keep out of that, and what you're going to do with it.
Right.
You know, one of the things that we do, the first step is just to do an appraisal. Having an appraisal in a company, we give it to the client and say, okay, now go see your CPA, go see your financial planner. See if this money will be able to support your lifestyle after the company is closed. And that's very important. So to have a financial planner who can invest your money, and we usually ask them to go and do those chores before they decide to sell the business. Why? Because we don't want to do in the middle of the transaction, find out that he's not happy, or mama home, not happy with whatever he's going to take home. So we want to make sure that everybody is in concurrent and they have enough money.
And that the attorney that you do have, you want one that is experienced in mergers and acquisitions. Sometimes we have clients that have had a corporate attorney for years and years and years, and they know them, they trust them, and they do a great job, but they don't really have a lot of time in transactions. And so there's like this learning curve almost. And we find that it's okay, maybe the best solution is it's okay to have that corporate attorney still involved in kind of giving you guidance, but to really bring in that expert, that M&A attorney that understands transactions and can communicate effectively with the buyer's counsel.
Yeah.
Okay. Yeah, I can see, you know, I always advise my clients that, you know, it's not just tax planning, but the financial investment as well. You know, what does their future look like once they've closed a deal? I always like to make sure that they have a financial professional that they feel comfortable with. Often sellers, they've never had this much money to invest before, and it's a little, disconcerting for them. So I really like them to be comfortable with a new financial professional if they switch, or maybe they haven't had one in the past. They've been investing all their money into their business, and there really hasn't been any brokerage accounts. But at the same time, the tax planning that goes into it too, they really need to understand the tax implications of the sale. In my experience, the sellers hear, they hear a big sale number, and they're already spending it in their mind. I'm going to buy this, I'm going to buy that, I'm going to fund the grandkids' college education. Right. And, sadly, when I give them the news about how much the tax is going to cost and the net number, then we kind of bring them down to reality, and then I, send them on to
reality check.
Yeah, a little bit of a reality check. And of course, we can structure the sale as best we can to minimize that tax liability, but then also so that we can send them on to the financial planner and give the financial planner some advance notice as to what monies are to be or available to be invested going forward, and what does that look like perhaps for their retirement, or maybe even a long period before they reach retirement. Sellers don't necessarily wait till retirement to sell their business. The one that I know is currently working with you right now, they're in their late 40s, and this might be a sale that they do, and then they might go on to something else. They're very entrepreneurial, so you never know. It's not very cut and dry.
And just mention on that, one other thing, a comment that is very important. People wait until they're ready to retire to start thinking about selling the business. At that point, and usually it's kind of late. You need to start thinking at least 3 to 5 years before. Preparing the business, preparing your financial, preparing yourself, and preparing the company for it. So it's never is too early to start preparing yourself for that. If you're waiting till you're 65 to sell the company, at that point, usually it is kind of late already. You have already forfeited some of the value of the company and the value of the goodwill. And the goodwill, like people say, it's right between your eyes with the owners, and they want to take it with them. And the value of the company many times just reside with the seller.
I could see that as well. So one last question. We just have about 2-3 minutes before we go to the Q&A session for our attendees. What steps would you suggest that an owner take to maximize the value of their business? Is there any we've gone through the obvious things, have the right teams, plan ahead, structure. Is there anything about managing their expectations a little bit?
Sure. Well, that would start with the evaluation. We never bring a company to the sale process without having an evaluation, which is a combination of an appraisal of the business and an assessment of the strengths and weaknesses of the business. If we identify red flags early on, then we can sit with our client and say, hey, beyond the value, here are the things that we see that are going to be problematic in the process. And we can move forward, but it may be at the expense of the transaction value, or it might be a deal that's a little more highly structured, meaning not quite as much cash at closing, a little more of a deferred payment. So we can consult with the client and make sure that we can formulate a process that they get what they want in the end, and they're not surprised when they start seeing offers come in.
Also, it's very important when we start early in time, they might have a customer and which are 10, 15, 20% of their production, and they have a good handshake. And that is fine, and it's been working for several years. Now, they don't have a handshake with the buyer, so we should document that. And if it's within possible, let's make a contract on it. Let's make a contract for 2 to 3 years that will reinforce the value of the company and reinforce the future value of the company. That is very important too. So preparedness, that's the most important thing. Get ready, prepare yourself.
I like to add, a thing here. One of the areas that really I know impresses a buyer, where they get the feeling like, wow, this company really has their, the wherewithal together, is the owners that take the time to track KPIs in the business. Most companies have an ERP system. Get to know what reports can be produced through your software platforms that you have in the company. And also get in the habit of producing monthly financial statements. You don't want to be in a situation where all of a sudden you're going through a process, a due diligence process, and just historically you close out your books, you're 2 to 3 months behind when you're closing your monthly P&L. We see that often. So get in the habit of closing the books, as quickly as possible at each month end. And also, it's not going to come as a surprise to your staff when all of a sudden you're making that request to them, which just comes out of nowhere.
Sure. Nick, can you explain for everyone what is KPI?
Yeah, KPIs would be key performance metrics of the business, key performance indicators of the business. Buyers want to see data. They want to see how you're tracking your performance. How are you successful? We understand that you're successful in the P&L, but is there anything more that you can show us? What's the ratio of quotes to bookings? How effective are your sales team? What is your go-to-market approach? How quickly are you guys able to get product out the door? Do you guys track any defects or products that customers receive, et cetera? Those would be just a few.
I'd like to make one comment that is very important, just to finalize how important what Nicholas is saying.
Okay.
We have a client, a nearly $100 million company who we engage, and we realize that the system that they have was not being utilized. So the accountant was taking the information from the system, put it in Excel, and then try to bring it to the accounting system. Well, right now, we have one of your CPAs been working with him for how long, Robert, now? 2 months, at least, with the trucking company?
Oh, yeah. Yeah, 3 or 4.
At least 2 months, and we are not ready. And I will say we probably will not be ready for a few more months. Yeah. So when he came to us, we don't know what the books look like internally. We see the results. In this case, he have already spending a lot of time. He's missing a very important window till the time that your firm, are be able to bring the books back to some order.
Right. Okay, well, we've reached the end of our general session. We do have a few questions from our audience. So who can answer this question for me? At what point should the key management be introduced to buyers during a sale process? And we only have about 8 minutes of our audience's time.
I could,
a few other questions as well.
Yeah, so I think when you have, that could be a sensitive area for a lot of owners. When do we, essentially let the cat out of the bag that we're going through a sale? And I would say, ideally, you like to do it earlier than later because it could help the transaction. It could help the value. A company is more than just the products and services it sells. It's the people. And, one of the ways that we've been able to go around the feeling of uncomfortability an owner may have in introducing key management is a buyer will normally want to tour the facility. They want to get a plant tour. And we've come up with some ways where we set up a disguise as we're a potential customer that the owner's bringing in. And then you have a key, management member give the tour. And that's been a very effective way for us to be able to introduce the management team for the owners that are more sensitive about, having that introduction, where the buyers get to ask questions and there's dialogue back and forth. But it really could help. And I would say, sooner rather than later.
You really give them an alter ego for them to visit?
Yeah, it depends.
Yeah,
so we had I either show up as a customer or for example, I've certainly shown up in a disguise too, an insurance guy. It's typically the owner wants to keep things on the hush hush, and when we see a bunch of people in suits walking in, people tend to look up and like, what's going on?
Okay, so a real world example to that in public accounting is that even in public accounting, firms are merging all the time. And my colleagues at other firms, it's a very small industry. We all know each other. And it's not often that partners from one firm meet with partners from another firm. And so when you put that on the calendar and the staff see that partner A is meeting with partner B, they're like, oh, what's up? So I can see the incognito method might be the best, or have some of those meetings off-site, at least initial discussions.
Right.
We do that a lot. We find a quick tour. Management will do a quick tour of the owner. And then there's usually a restaurant or a conference room in a hotel that we gather up after that. So it's not as much of a distraction.
Yeah. I can understand them wanting to tour the facility, but at least to see, you don't at least give it away before you're really ready to give it away. Right. So my last question, we have a few minutes left. Perhaps we'll have time for a second one, but this isn't my question, it's one of the audience questions. What's the biggest piece of advice that you can give to a business owner who is about to go through due diligence?
Well, I think at a high level is make sure that you really want it to happen, because sometimes we find clients are excited about the idea, but when you get to the point where the deal is actually happening and you're starting to think about notifying your employees and pulling your personal items out of your office, that it really hits home. So be thinking about, do you really want this to happen? Because we'll get you to that point.
Be careful what you want.
We'll sell it.
We'll take you there.
I could see that. So how can an M&A advisor help an owner during the due diligence process?
You know, you were talking about the team, and we also, also act as a therapist to the owner too. So we'll get calls and tell us what's going on. That's fine.
I tell my clients I have a psychology degree all the time.
Oh, absolutely. I mean, some of the clients, they get grumpy, and I'm like, I'll say, George, you see this email? He's getting a little snotty here.
Okay, and I think we have time for perhaps one last question, and this is, we might have touched on this, but what do you see more of? Offers which contemplate an asset sale or a stock sale?
I think more, Nick was addressing this earlier, I think more asset sales. We are seeing what's sort of like a hybrid, where oftentimes an owner wants the benefit of an asset sale, but they also want to acquire the corporation because it makes it easier to transfer and take over. And so there is a structure where the contract is essentially a stock agreement, but the IRS allows for the benefit of an asset purchase, which is where you're stepping up the basis of the assets of the company.
I do have a new question that's just come in. So what about a service industry that is similar to many other businesses except for the excellence of its owners and has no inventory?
Well, just in time is good. Just in time is good. We have sold many companies in which, I remember a fishing company, a company who sells fish. We call it a fishing company. He was bringing fish from all over the world. And the guy was working from a small office in New York, and the containers will arrive, and from there they will disseminate it to different parts directly. He'll never touch he used to tell me, he said, I don't smell like fish, I never touch them. So we work on those. The key for that is to be able to have non-customer concentration.
Okay.
Because if you have a customer concentration, it's really difficult because the relationship is with him. And he doesn't have team with him. A person who doesn't have inventory usually doesn't manufacture anything. Well, if he doesn't manufacture anything and he just purchase and sell it, and sometimes direct shipments, it's just be able to have a diversification. That's very important.
Okay, I could see that. Okay, we're getting to the end though, so I think it might be time for us to wrap this up. So Jill Zozula, if you could, take over and close it out for us, we'd appreciate that. Thank you everyone for your time and attention.
Thank you.
Thank you, Pam.
Thank you, Pam. And Robert, George, and Nick, we want to thank you so much for coming today and speaking with our clients about this topic. We've had so many people ask us questions about this, and we thought what better way to answer them than to have you guys come. So we really appreciate your time. All of you on the webinar today, make sure you check your inbox later today, because you will get a recap checklist of everything that they talked about, as well as a recording link if you wanted to listen to it again. And wanted to let you know that we've also got one other webinar coming up, and that will be on April 9th, and it is ways to decrease the expenses in your business. And a lot of you have also asked us, my business is making money, but I'm seeing a lot of it go out the door for expenses XYZ. So we're going to actually talk to you about how to reduce those expenses. So everyone, I wanted to thank you all again. Check your inbox, like I said, this afternoon, and have a great afternoon.
Thank you.
Thank you.
Thank you.
Bye, everyone.
Bye.